This is the first part of our Chapter 10 video lecture series. In Chapter 10, we are going to discuss the weighted average cost of capital. A weighted average is just that, a weighted average. So think back to taking the beta of a portfolio. That was the weighted average of the betas of the portfolio's components. Weight times cost, or weight times beta plus weight times beta. So we're going to do that same kind of thing, but now we're going to do it for all the various sources of financing for your corporation in order to get the weighted average cost of the financing for your corporation. So what exactly is capital? Capital is just money. And what we're going to be doing in this chapter is examining the various sources of financing, sources of money that your company uses. So remember, our companies finance with debt, equity, and preferred stock. We've already talked in previous chapters about how to calculate the costs of debt, equity, and preferred stock. Now we're going to put them all together. So what causes the cost of capital to increase? Well, market fluctuations. When the market is in a recession and we're dealing with a credit crunch, right, where it's really hard to get loans, then the cost of capital for everything will go up. In riskier times, it's more risky to invest in a stock. Therefore, the stock requires a higher rate of return. So that seems logical. Interest rate fluctuations. The Fed has cut rates to historic lows, right? So now interest rates are down, which causes the cost of debt to go down. The optimal capital structure that a firm can have can cause the cost of capital to fluctuate. So we'll talk about how a company makes a decision about what type of capital structure to pursue, whether it focuses more on debt or equity, and we'll discuss some hidden costs associated with equity. And then dividend policy. Depending on where the company is in its life cycle, it may pay out more in dividends and therefore reinvest less into the company, therefore causing its growth rate to decline, which will have an impact on the overall cost of capital. And finally, it's investment policy, which is linked to the dividend policy, right? If it's not taking the earnings and paying them out in the form of dividends, it's deciding to reinvest into the firm. So here are different sources of financing, which leads to our capital structure. Remember, capital just means money. So when we're talking about capital structure, we're talking about where does our company get its money from. It has three basic choices: debt, equity, and preferred stock. In debt, it has two choices: short-term or long-term. Now we know in general, long-term debt, think about a car lease or your student loans, right? The longer the time period it takes you to pay back, the lower the interest rate is, but the more you end up having to pay back for it. So a company would choose longer term debt if it could only afford a lower coupon rate, but realize that it would be paying more in the long run for that, versus shorter term debt. Just think about, again, your car loans versus your student loans, and you will recall that when you had a shorter time period, you had a higher coupon payment that you needed to make. Now, for equity, which is common stock, so you'll hear those used interchangeably. It'll get a little confusing. Common stock, common equity, equity position, stock are all kind of used interchangeably. So remember from way back in the beginning, common stock is a function of retained earnings and common stock. So common equity, retained earnings, common stock, and we can also include in there new common stock. A company may decide to issue new stock to the market. And preferred stock is our final choice. What is preferred stock? Preferred stock is a little bit different than common stock, which is common equity. With preferred stock, the shareholders get a pre-specified dividend and it doesn't change. So this reduces the equation for figuring out the price. Remember, the price of a stock is the present value of all future expected dividends divided by R minus G. So P0 equals DIV1 divided by the quantity R minus G. Well, with preferred stock, G is held constant. There is no G because it's not growing at all. So the equation reduces to P0 equals DIV1 over R. With preferred stock, the dividends get paid to preferred stockholders first. That's why they're called preferred. Because if the company is going to issue dividends, it's going to have to pay them to the preferred stockholders first. So now we can order these costs of capital in their order. In general, debt tends to be the least risky, and therefore it requires the lowest rate of return. The absolute lowest rate of return there is on the long-term debt. Remember, the coupon rate or coupon payments were lowest on long-term debt, followed by short-term debt. Then, in terms of risk, and why is debt the cheapest source of financing? Because debt holders get paid out first in the event of bankruptcy. So since they have first claim on the assets, they face the least amount of risk. And remember, we have the general idea, the higher the risk, the higher the required return. Next in line comes preferred stockholders. They face less risk than common stockholders, but more risk than debt holders. If the company is going to issue dividends, it pays them out to the preferred stockholders first. And then finally, common stockholders face the most risk. They are the least likely to get paid out in the event of bankruptcy or any kind of financial distress. And since they face the most risk, they require the highest possible rate of return. So we put this all together to come up with the weighted average cost of capital. Remember, when we're talking about a weighted average, we're going to do a weight times a cost plus a weight times a cost. So all this equation says the weight of debt times the cost of debt. We'll talk about this 1 minus t in just a second, plus the weight on preferred stock times the cost of preferred stock, plus the weight coming from common stock or common equity times the cost of common equity. So the R's are all of the costs. RD, cost of debt. RP or RPS, cost of preferred stock. RC or RS or RCS or RE, you'll see it listed all of those ways. Those are the costs of common stock or common equity. Now, what is this 1 minus T? Well, you'll note that interest paid on debt is tax deductible. So this 1 minus T means 1 minus the tax rate. So for debt, we will be dealing with an after-tax cost of debt. So not only is debt in general the cheapest source of financing available to a company, but it also has a tax advantage. You get to lower your overall cost of debt by the amount of interest that is tax deductible. So remember, RD is your cost of debt, and since interest paid on debt is tax deductible, you'll take your RD and multiply it times 1 minus your tax rate to get your after-tax cost of debt. So when we plug all of these variables into our formula, we come up with something known as WACC, which is the weighted average cost of capital, or the weighted average of debt and equity returns. This is the minimum that the firm must earn on all of its assets in order to satisfy all of its security holders. So this is the rate of return that we will get. It's the weighted average of all of the different costs of capital that the firm uses.